Okay, so we just waited on a few more minutes there to make sure that there was no late stragglers, but it appears that this is us for this evening. So welcome again to the second of our 3 evening sessions tonight. I'm sure you'll find our talk of major interest, whether you're PQS, contractors QS, employers agents. We have he doesn't like to call himself an expert, but if there was an expert in the insurance industry for construction, Lawrence would be that person. So without further ado, I think Lawrence can do his own CV, as he would be the only person to be able to give it justice. So,
okay, thank you. And after that introduction, the fee's just gone up. Right, I'm not very good with technology, so bear with me. I left school when I was 16, in May 1968, so you can all work it out. I went to work in insurance. I worked for insurance companies for 13 years. I then made what was a fairly major step in that I went to work for a contractor in their insurance function, insurance department. That contractor was called AMEC. Some of you may have heard of it. Or you may have heard of Fairclough Construction or William Press, but all part and parcel of AMEC. I spent over 20 years there. The last 12, I was their global head of insurance, placing an insurance program with a premium spend of £45 million when I left, based on a turnover of £6 billion. Am I an expert? Did that make me an expert? No, it taught me a hell of a lot. I don't know it all. I still learn now. I now work for a company called AON. Some of you may know the name. According to our PR people, you should do, if you're football supporters, because it's on Wayne Rooney's chest every Saturday. We sponsor their shirt. It cost AON a fortune. Still does. But it gets our name known. Within AON, I'm the UK technical advisor on construction. So I've been doing it over 30 years. Hopefully, I can pass some of that knowledge on to you this evening in your jobs or in your degree course. Just out of interest, how many of you are either working in the construction industry at the moment and doing this part-time, or have done some work during the course of your full-time studies? Fair number. How many of you have come across insurance during that time? Not many. Did it frighten you? Just out of interest? Or did you not get that close to it that it couldn't frighten you? Silence. Must have frightened them. Insurance is not something to be frightened of. We make it sound as though it is, because then you employ people like me to give you advice. But it's not rocket science. And hopefully you'll get that impression during the course of this evening. We're going to have a quick overview of the construction industry, not in a great deal of detail, because you probably know more about that than I do. A little bit of education about some insurance terms, because it may help during the course of the evening. Quick talk about contracts, construction contracts. And then the main things are indemnity clauses within contracts and the main insurance covers, and focusing in on 2 main contracts, JCT form and the NEC. Overview. Most of these terms you're all going to know. There's building, there's civil engineering, M&E. Anybody come across PFI? Anybody got involved in PFI? It's wonderful. Not. It's a highly overrated way of the government building hospitals and schools and then leaving people with massive mortgages. But from a construction point of view, it's absolutely fantastic. Generated a lot of work, and for QSs, created a lot of work because the contracts are a minefield. Absolute minefield. Anybody ever got involved in a joint venture so far? Right, well, they're very quick. Do you understand the concept of a joint venture? Yeah? Joint venture is two or more people coming together to do a job. The biggest I got involved was a joint venture known as Canberra. Carillion, Alfred McAlpine, Balfour Beatty, AMEC joint venture to build the M5 toll road north of Birmingham. Wonderful road, doesn't have a lot of traffic on it because it's too expensive. But that was probably the biggest joint venture in this country ever. The contract price was over £600 million to build that road. And it came in on time and to budget, thankfully. But the concept of joint ventures is they're either incorporated, limited company, or they're not. They're just a partnership. And they can either be integrated or non-integrated. And by that I mean, if they're integrated, the partners to the joint venture all work together and you never know which one has done a particular piece of work. Whereas non-integrated, AMEC used to do it with Alfred McAlpine. Max used to do the blacktop. AMEC did the bridges on roads. And you knew exactly who did which bit. So if there was a problem, you knew where to point the finger. With an integrated one, it could have been any of the partners. Partnerships are something that's coming on board these days, mainly from the employer's side to get contractors on board. Come and join us. Sorry you missed a bit, but mainly with local authorities who get into partnership with contractors to do certain works. Could be maintenance work, could be in houses, could be on roads. But there is a contract there. The main point I think you're going to realise tonight is that there are many and varied contracts around in this industry. But the insurances are all on a theme. The words might be different, clause numbers will be different, but the basic underlying requirements are the same. Quick talk about insurance. Insurance is a contract between you, if you own a car, and your motor insurer. It's a contract. It's in writing. You pay a premium and they agree to do certain things when events happen. So if you have an accident and you've got third-party only cover, they will pay for the damage you cause or the injury you create to people. The basic understanding of that contract is that it will indemnify you. And that means it will put you back in the position you were before the incident happened. So if you take a house insurance and there is a fire in the house, it will pay to rebuild the house to the state it was before the fire occurred. Not better necessarily, not worse. There's always a problem with that because the house might be 50 years old. When the fire occurs, you're going to use new material. So you can extend the indemnity to a new for old basis. But beware. Be very aware. There is a thing called utmost good faith in the insurance industry. It's an underlying doctrine that says that when you arrange your insurance, you will tell the insurer all the information he needs to know, even if he doesn't ask you for it. You're meant to know. So let's get it back to motor cars, because it's always a good one. If your parents have a spare car, which they are going to let you use, they should tell the insurer that you're going to be the main driver. And of course the insurer will rate the premium on your age, not your parents' age. What a lot of parents do is not to say that. And you'll be surprised how often that causes problems when an accident does occur. So it's all about giving the information to the insurer to let them make the right decisions and charge the right premium for the cover that you want. Be honest. Most policies have a limit. That's the maximum the insurer will pay. You used to be able to buy a certain type of insurance which was unlimited. You can't anymore. It will have a limit on it. It might be a few £100. It might be hundreds of millions of pounds. Depends on the policy, but there will be a limit. And there will also be an excess, i.e. the amount that you will pay towards a claim. I mean, taking a car again, if it's insured comprehensively, you will be responsible for the first £50, £100, £200 for repairing any damage. And after that, the insurer will pay the balance. You also have to have an interest in whatever it is you're insuring to be able to insure it. Called insurable interest, surprisingly. So I can't insure James's property. It's nothing to do with me. I can't insure his life, should he drop dead, sorry. Unless he owes me money. If he owed me money, then I could, because I've got a financial interest in him. And there was a time when insurance first started back in 1700 and something, that when life assurance first started, members of the public used to insure the king or queen. Didn't have an interest in him or her, but they knew that sometime they'd die. But the insurance market got a bit fed up with that one and decided to knock it on the head. So you can't anymore. I should also say, and I should have said this at the beginning, well, I will take questions at the end, if there are any. But if you want me to go over anything during the course of this, to clarify something, put your hand up and we'll take questions as they arise. Contracts. JCT is probably the best known building contract in this country. It's been around for years, 1968-ish, and has been amended and updated, but probably accounts for so many building contracts these days. Probably 80% of the work done in this country is done, building work done, is done under a JCT form. Everybody knows it, everybody understands it. But then people decided a few years ago it needed something better. And they came up with the NEC form, which really missed its mark. It's very much plain English, tried to be simple, has never been before the courts, as far as I'm aware, to test any of its clauses. In theory you shouldn't, because it's meant to be a document where everybody works together and comes up with an answer. We'll see. It is being used more and more now, particularly in the public sector. I think the government have sort of given it a bit of a push and said we'd like to use this. You will come across special contracts all over the place. Excuse me. If you work for BP, Shell, any of the big oil companies, Tesco, Sainsbury's, Marks and Spencer's, British Airport Authority, a whole host of other major organisations, they do not use JCT. They have their own special contract form. It's based on a JCT form, most of them, the ones I've seen, apart from the oil companies. But they have amended it to suit their needs and their requirements. And in this day and age, no lawyers here, are there? Good. Lawyers now will take a standard JCT form and change it for the sheer hell of it, in my opinion. And they would take an NEC and change that. So everything is getting changed. Plus there are also millions of other contracts that are out there. Some very good, some not so good. And you get people who create their own. In my days at AMEC, I had a QS. Well, I didn't, he worked for a subsidiary. And he decided to create his own contract for a particular job on a contract. Muck shifting. And he took a bit of the JCT, he took a bit of the ICE contract, and he took a bit of CPA conditions of plant hire, and put them all together. And there was an accident. Lorry was leaving the site, had to go under some overhead pipes that were pushing liquid from one side of a factory to another. And he had his tipper up, and he shouldn't have had. And he smacked the pipes and broke them. And when I came to look at the contract to show that this tipper driver and his company were responsible, I discovered the biggest cock-up I've ever come across in my life, and it cost AMEC £150,000, or their insurance. And the QS went very quickly. So the word of warning, if you're going to make up a set of contract conditions, and I'm not stopping you, be very careful what you're doing, get it checked by other people before you put it into place. This guy hadn't had it checked, didn't even let his bosses know he was doing it. So it cost a lot of money. Simple mistake. He'd forgotten to put something in, like an insurance clause and an indemnity clause. Cost him his job as well. Talking of indemnity clauses, anybody here ever read one in the contracts that you may have come across, or the specimen contract you may be studying as part of the course? Read them when you get a chance. Read them and understand them. They are so important to what you are or your companies are going to accept responsibility for, and how they're going to accept it. JCT has two clauses, and in the latest editions it's 6.1 and 6.2. 6.1 is the indemnity the contractor gives to the employer in respect of injuries they cause to people whilst doing the works. That indemnity is that the contractor is responsible for any injury arising out of the works, whether they are negligent or not, and to accept to the extent that the employer was responsible. So when somebody's injured on a site, the first party that takes responsibility is the contractor, even if they haven't caused it, unless they can show that the employer did cause it in some way, shape or form. Quite an onerous indemnity they give. I'm not sure a lot of contractors understand it, but the indemnity under the JCT for damage to property, and when I say that, I don't mean damage to the works that they're building, I mean property outside of the works, under 6.2, is the contractor is only responsible when they are negligent, and to the extent that they are negligent. So it's a slightly different twist. But not everybody understands it. But that's where they pick up these responsibilities. The other thing to bear in mind on virtually every indemnity clause you will see is there is no cap, no financial cap on it. It is unlimited. So if you cause a claim, whether it be £10, 10 million or 100 million, the contractor will be responsible if that's the way the indemnity clause works. The NEC is slightly different. The indemnity that the contractor gives to the employer, I'll give you the clause number later, is 2 lines. Very, very simple. It says the contractor is responsible for anything that is not the responsibility of the employer in the clause above. So the clause above is the employer's indemnity to the contractor, and it says the employer is responsible for, I can't remember them all off the top of my head, but it's clause 80. There is a list. And it's things like employer's design, use or occupation of the site to carry out the works, that's the employer's responsibility. Loss or damage to plant and materials supplied to the contractor, which are the property of the employer. War, strikes, radioactive contamination, and there's a list. Those are the things that the employer is responsible for. Anything else that happens on that site is down to the contractor. Unless the employer has put into the contract data some other risks that they're prepared to take. And the usual one is responsibility for an existing building, which the NEC totally ignores where you're doing a refurb. Doesn't talk about the rest of the building. Only talks about the works that are going to be carried out. Hold harmless. Anybody come across that term before? If you worked in the petrochemical, oil and gas industries, you will have seen it in every contract. It basically says that the contractor is responsible for its own staff, its own property, but not anything to do with the employer's staff or property, regardless of cause and who caused it. If you work in the oil and gas industry, you'll find when you sign a contract, you will sign, I won't say hundreds, but 50 or 60 separate side agreements between you as a contractor and other contractors who will be working on the site or on the rig. Everybody's responsible for their own stuff. End of story. It has a slightly macabre other name. It's called bury your own dead. Because no matter how an employee might be killed, it's your responsibility. You don't see them much more in this country other than oil and gas, petrochemical. See a lot of hold harmless agreements in the Middle East and South America. As long as you understand them and you manage the risk, they're not a problem. But a lot of people don't understand them and a lot of people don't read them. Any questions so far? Silence. Have I sent them to sleep, do you reckon? JCT insurance clauses. We've looked at 6162. 64 is where the contractor is required to insure his liabilities, either under a public liability insurance or an employer's liability insurance, and we'll come to that in a little while as to what they actually cover. Employer's liability has to be in compliance with current legislation. There is an Act of Parliament to do with that type of insurance. It specifies a minimum level of indemnity, which is £10 million at the moment. Most companies, unless you're a very small company, will buy a lot more, depending upon the size of your staff and your accumulation risk. I sat down once at AMEC and tried to work out, with the biggest office we had, there were 420 people based in that office. What would it cost us if it blew up? How many people would walk out? how many people with no injuries, how many people would walk out with cuts and bruises, how many people would be on stretchers, and how many would be dead? Not an easy thing to do, it's almost impossible, but it led us to believe that we should be buying at least £400 million worth of liability coverage to protect AMEC and its balance sheet. Whether that was enough, no idea. Hopefully the building will never blow up. But you've only got to look at things like Piper Alpha. And there were, well, 170 odd people on board that rig when it blew. And it cost the insurance industry then certainly over £150 million for the injuries and deaths, never mind the rig. So just buying 10 million sometimes is not enough. But that's the minimum level. For the public liability, the employer will put a minimum level of insurance in the contract particulars. And Pound to a Penny says they'll put 5 million. No thought goes into it. Nobody thinks about it. The employer will have got advice from the wrong people. And we'll just be told, oh, everybody puts £5 million in. Never mind what the exposure is. Is the exposure you're doing a building in the middle of Dartmoor and all you've got is some sheep? Or are you doing one in the middle of Liverpool? Where if a crane came down, and one did, so I'm not making this up, and it was nothing to do with AMEC, but a crane did collapse in Liverpool a few years ago. Thankfully it didn't, I don't think it injured any passers-by to the site, but there were certainly some injuries to workers. £5 million minimum limit. Most small contractors will buy no more than 5. Big contractors will buy hundreds of £1 million because they look at their exposures. And bearing in mind the indemnity is unlimited, if they have a claim that goes through their insurance, it comes back on their balance sheet. And nobody wants the balance sheet hit because it's going to affect the company and affect employment going forwards. 6.5. I can take you back to this when it was 19.2A insurance in the 68 edition and 21.2.1 when it was in the 94 edition. It's now 6.5.1. Probably the most misunderstood piece of insurance in a contract that has ever been invented. Contractor is to buy something for the employer. And it's to do with risks arising out of certain operations which may or may not be happening. We're talking about heavy piling, deep excavations, heavy vibration, dewatering, removal of or weakening of support of surrounding properties, where damage occurs where the contractor has not been negligent. It's only occurred because the employer wanted his building, whatever, put there. It's often asked for when it's not needed, and when it is needed, it often isn't asked for because people don't understand it. It's quite simple when you read the clause. It's quite a long clause, but it's quite simple when you read it, and I would recommend that you do. Because I know you all love sitting at home reading contract clauses. Because I don't. I do it at work, but I don't do it at home. But sometimes you've got to learn them and understand them, you've got to sit down and read them and get to grips with them. And I'll say this, if you get to grips with the insurances on a contract as a QS, you'll be the only one probably in the business that you're working for. Because everybody says, oh, it's insurance. It's too difficult. People leave it to the last minute. It goes wrong and there's a problem. I suppose I'm biased because I work in the insurance world. But I've seen it too many times. you talk to people about fairly standard, well-used contract clauses, they've never read them. People are signing stuff and they don't read, but anyway. So, 651, get to know it, get to understand it. And then you can be positive when people start asking questions going forwards. 6.6 is the accepted risks. These are the things that the contractor's not responsible for. We're back to things like war, nuclear, terrorism, where it's not within the definition of terrorism, whatever that means. But they're the things that the employer is responsible for. 6.7 is the insurance of the works, and there are 3 options on JCT. They're very, very simple. Option A is new build, contractor to insure the works. Pretty standard. Option B, new build, employer to insure. Because some employers do like to arrange the insurance. It's their asset. They want to make sure it's properly covered if something happens to it. Option C, extensions or refurbishments to an existing building. The employer is to insure the works, and the employer will also add the contractor to the employer's property policy on the rest of the building. It relieves the contractor of a major exposure for causing damage to the building by the specified perils. And wherever possible, it should be done. Biggest problem we have at the moment is where the employer is in a building that they are leasing from somebody. A lot of landlords now are saying we will not add the contractor. Can create a major exposure, as I've said. I've done one a couple of years ago for a small contractor doing some refurbishment work on 10th floor of Canary Wharf in London. The landlord would not name them on their property policy. And when we inquired what Canary Wharf was worth, it landed the contractor with a potential liability of £1 billion, should he bring the thing down totally. Which was ridiculous. I mean, it was a £75,000 contract. You can't even buy £1 billion worth of liability coverage. Well, not within 75 grand anyway. It took a lot of work talking to the landlord, and eventually we came to a compromise where the contractor was responsible for the first £10 million, which he had as insurance. It was the limit of his liability coverage. So he was happy. The landlord was happy, and the job went ahead. But more and more we are seeing these where the landlord says no. If you're working for an employer and that happens, don't forget you'd need to amend the contract because you haven't provided that insurance. So you'd have to let the contractor know and change the wording. But hopefully the lawyers will take care of that. 6.8 is just a whole load of definitions to do with contract works insurance, what it is, who should be insured, what terrorism is. 6.9 is protection for subcontractors in respect of damage to the works, where the contractor or the employer should name the subcontractors on the works insurance against damage by specified perils, just to give the subby some protection that he's not paying for. Six, 10 and 11 really relate to terrorism. 11's easy. If terrorism insurance is no longer available, the contractor just goes to the employer and says, I can't buy it. What do I do now, Mr. Employer? It is available, and unless there's a whole load more of terrorist activity, in and around this country. And terrorist includes people like animal liberation. It's not just political, from an insurance perspective. And I have known that. I mean, I am aware of an incident where somebody was going home from work on a particularly delicate site that animal liberation were targeting, and found a bomb underneath his car because there was a shadow on the ground that he thought, that's funny. And when he looked, there was something clamped to the bottom of his car. We called the police, they called bomb squad, and it was diffused, etc. But I'm not trying to frighten people. It's something that can happen. Terrorism premium. At the moment you can only buy terrorism insurance for 12 months, so if you're pricing up a 3-year project, you've got to make a guess as to what it's going to be in years 2 and 3. This is just a facility for you at the end of year 2 or the end of year 3 to say, go back to the employer and say, I made a guess, I got it wrong, it's gone up, it's gone down, and you can adjust it. It's a fairly recent one, nothing contagious. That's going to cause major problems. So 12 and 13, to do with professional indemnity. I won't go into what it covers at the moment, but it says, particularly if it's a design and build contract, contractor will buy and maintain for a period of 12 years from date of completion professional indemnity insurance to a value of, as detailed in the contract particulars. Contract particulars will have an amount, 5, 10 million, as either any one claim or in the annual aggregate. The difference being, any one claim is what it says, any one claim. The annual aggregate means you only get £10 million in any 1 year. And once you've burnt through that, if you have that many claims, you've got a problem. Fairly straightforward. And the final bit relates to Joint Fire Code. Because of some fairly major fires back in the 90s, particularly in London, multi-million pound fires, the insurance industry and the construction industry got together and came up with this fire code. It's now on its 7th edition. It applies to any building contract with a value in excess of 2.5 million. The contractor is required to comply with it. The insurer has a right to inspect and survey, and if they find that the contractor is not complying, they can, if they so wish, suspend cover, stop the job, which you don't want if you're a contractor. So people need to know and understand it. Now, I don't know, has anybody ever read it? It's great reading. If you want to go to sleep, it is anyway. If you like, I can send James an electronic copy. You never got it from me because there are copyright issues. But I can send you the email. I can send you an email with it attached, and then you just delete the email. If anybody then wants to go to James and ask him for a copy, that's entirely up to you. Or you can buy it from the Fire Prevention Authority for a tenner. It's up to you. But I will send you it. But as a contractor on site, you've got to comply. A lot of it is just common sense. It becomes a problem when you go over 20 million and you start building high-rise towers. There's all sorts of things that have got to be done then to protect, make sure that the fire doesn't use the tower as a chimney and spread that way. So there are cost implications as well for the contractor. Questions? They're doing quite well. Maybe they all want to go home and watch Man U against Ajax. Then they can see our wonderful name even better. Sorry, couldn't resist that one. And I say that as a Charlton supporter, so NEC. Clause 80 is the employer's risk, we talked about that. 81, contractor's risk. 82 are what you do if there's any damage and you want to carry out repairs. You have to let the employer know and get agreement and so on. 83 is the indemnity, which really reflects 80 and 81. 84 just sets out the insurance cover in a table. And the thing about the NEC is that there's only one option in the contract. The contractor will insure these things in the table. The works, the liabilities, plant and machinery, and such like. So it's very close to being the same as JCT, but not quite. It's a variation. 85 says the contractor will produce copy policies, confirmation the cover is in place. 86, what you do if the contractor has not insured. You'd be surprised occasionally how that happens. It gives the employer the right to go out and buy the cover and charge the contractor. And usually, the employer doesn't give two hoots how much he pays, because he's just going to charge you back. So he's not bothered. And there's nothing you as a contractor, if you are working for a contractor, can do about it. So make sure you've always got evidence that the cover's there and it's valid and in force and you've paid the premiums. 87 just gives the employer the option to arrange some of the insurances up front, but he has to put it in the contract data at tender stage and tell you what he's going to do. If he doesn't, it's just as per standard. Fairly simple, fairly straightforward. It's not that difficult, it's only 2.5 pages in the NEC. Doesn't take a lot of reading. But again, I would recommend people read it and get to know and understand it. Now the bit you've really been waiting for. What do these policies cover? I do this within AON, and it takes me a day to teach the youngsters in AON what these cover. We haven't got a day. I don't expect you to become experts. I hope after this you will have a basic understanding. Public liability, sometimes known as third-party liability. It is the liability of any, let's talk about corporations, businesses, any corporation or business to people that aren't part of their operation. So the university has a potential liability to me if I injure myself while I'm on this property, which I nearly did earlier because I didn't realise there was a ramp down there. I didn't see the yellow bits. I didn't fall over and I didn't help myself, so don't worry, I'm not going to make a claim. On a construction site, it is equipment falling onto pavements. It's visitors to the site who fall down holes, trip over equipment, stuff that's lying around, and then sue the company for damages, for their injuries and all the rest of it. That's what a public liability policy picks up. It picks up that liability. It could be damage to property. Let me think of a good example from my past. Yeah. Oh, yeah. Small contract, £125,000 to refurb a warehouse. Part of the refurb was cleaning the roof, which was covered in moss and grass and God knows what. That bit was subcontracted to a specialist who went up onto the roof with the most powerful water jet he could get up there, and he blasted it. And the moss and the grass came off beautifully. Inside the building, it snowed. It was a corrugated asbestos roof. There were 42 people working in that warehouse. The names are all logged with the insurers. There were also, can't remember the exact number, approaching 30,000 pieces of paper. It was the depository for a major bank and all its legal documents. It cost £7.5 million to clean the documents by a specialist asbestos cleaner. The 42 people, hopefully, will never, ever, ever have a problem. But as I say, their names are logged with the relevant insurers, and we just wait. Hopefully, nothing will happen to them. From a little acorn, I was about to swear then, a big claim occurred. And that's what a public liability policy will pick up. The subcontractor had public liability insurance for £1 million. That's all he had. So the AMEC insurers took the £1 million, had a look at him to see if he had, if he was a silent multi-millionaire. No, he wasn't. He had nothing. So he went. We paid the bill again. Bad management. Nobody did a risk assessment. Nobody looked at the insurance aspects properly because it was a small job. So, point of learning, don't assume it's a small job, there's no exposure there. There is, somewhere. But that's a PL policy. AMEC, apart from buying 400 million of employers' liability, we also bought 400 million public liability. Employers' liability, slightly different. It is a liability policy, protects the company against accidents and injuries to its employees. So whilst you're working for XYZ construction company, if you fall down or fall off or trip over or in some way damage yourself or injure yourself, or if you get one of the various industrial diseases, you're probably too young to have deafness yet. You certainly won't have asbestos. The one you're probably going to get is repetitive strain, but that won't be from working, that'll be from texting people. But it could be from the computer, if you have to do a lot of computer work. But it's that sort of, an injury or an illness or something at work, and your employer has been negligent. So they have not trained you correctly, they've not given you the right equipment. That's what employers' liability insurance is for. Every company must have it by law. There was a restriction if it was a company with less than 2 employees. The government are looking at that again because there's now so many small companies that have been set up by people for tax reasons that they're wondering if they ought to include them. It's up to them. Contract work, from a contractor's point of view and the employer, one of the most important. Something is being built and it will be an asset to that company. Whilst it's being built, they don't want anything to happen to it. They want it built without a problem, to time, to budget. But if something does happen, a fire, a flood, collapse of some description, they need to make sure there's going to be an insurance policy there that's going to pay to rebuild it, get it back to where it was. And that's a contract works insurance. You will occasionally see it described as a CAR, not car, but CAR, capital letters, contractors all risks insurance. But it's the one that's covering the works, whatever they may be, as defined in the contract. Against an all risk basis, including terrorism, and you have to produce evidence, but all risk is all risk. It says that if the works are lost or damaged from any cause unless excluded, the insurer will pay. And then you have to look at the exclusions, and they can vary from policy to policy. But unless you want to spend the rest of the evening learning about that, I don't think we'll go into that depth of detail. Contract works is there to insure the works and protect it if it's damaged. Professional indemnity. Applies to people who are carrying out a professional activity when they make a mistake. So we're talking about architects, engineers. We are talking about quantity surveyors in a very limited way. Usually it will pick up where you have misinterpreted a bill of quants or something. It doesn't pick up your mathematical errors. So if you multiply 5 by 2 and get 12, tough. But if you've made a decision there should be 1,000 bricks and you made a professional misinterpretation, it should have been 5,000 bricks, you can get those claims paid. But it is the professional error. Example, new office block, put up, steel frame, concrete, breeze block infill, cladding on the outside, finished, done. Employer moves in, brings all his staff in, brings all the stuff, filing cabinet, desk, chairs, etc., etc. And then people start to complain that the building's moving. Not a lot, but just a bit. Investigations are carried out. Nobody thinks there's a problem. But the staff still maintain that there is a problem. And after 18 months, somebody checked the structural engineer's calculation and he put a decimal point in the wrong place. Steel work was under design by a multiple of 10. And the building was on the verge of collapse. Building evacuated, employee goes off, finds temporary accommodation, carries on his business. Building is totally wrecked, completely demolished and rebuilt properly. Total claim, just under 10 million. Structural engineer, small business, had 1.5 million, 1.5 million of PI cover, nowhere near enough. Their insurers paid that. Man was of straw. AMEC. What happened to AMEC? Nobody else. Insurers paid up for the balance. It was a mistake. It was an error. That's what it's there for, to pay to put it right and to pay the other costs that flow from that. They can be small claims, very rare they are. They're normally biggies. You don't get to hear about them very often because people don't like admitting that they've made a mistake. But it is an important area of insurance. Just going to touch on 3 others, 2 very quickly, 1 a bit more. Archaeological insurance is available such that if, whilst you're doing the works, you discover an archaeological site that wasn't known about in the first place, this insurance will kick in and protect the employer against the costs of the delay. Because once you find an archaeological site, the job will stop, whilst the boffins get in and do their digging and whatever else they do, and establish exactly what is there. Very rarely bought, because if you want to buy it, you've got to produce an archaeological report by experts that says that there is or there isn't a site, and they do all sorts of desk inquiries. But it's there if the employer wants it. Latent defect is something that came out of the French system. Over there it's known as décennal insurance. Over here it's latent defect, and it's really to protect an employer once the building's finished. If there is a latent defect that's going to cause the building to collapse, he doesn't have to go around looking for who caused the problem. He has an insurance policy that will just pay for the repairs and leave the insurer to chase after any recovery. Really down to employers, property developers. It is bought fairly regularly, but if you work for a contractor, it's not something that concerns you. Delay cover. I'm going to ask a question now, we'll see if we get an answer. You're working to a JCT contract, you are building a building, there is 6 weeks before completion, there is a major fire, the entire building is gutted. It's going to delay the job for months. What right do you have under the contract? Anybody prepared to stick their hand up and go on? They're whispering. You kick yourselves if you're right.
Can I have an answer?
Yeah.
So the contractor would be potentially entitled to an extension of time, and the employer would be entitled to the zippity zip, and his LADs wouldn't cover.
Exactly. First letter you would write, you'd make a phone call to the insurers to get them on site. The first letter you'd write is to the employer, informing him of the fire officially and claiming an extension of time under the contract, because fire damage is a relief event, as are various other bits of insured damage. Once you've got the extension of time, you are relieved of your exposure to the liquidated damages, because they're going to be pushed out to the new date. But the employer has a problem. He's not getting his liquidated damages. Now, if it's a new factory, he was hoping for more turnover, more profits. But I'll give you an example again of a hotel. It was a brand new hotel, and it was actually 3 days before completion. They were doing the final snagging list, going round, making sure the rooms were neat and tidy and what have you. And overnight, a pipe in the ceiling void did that. And somebody left the water on. And so the water poured out overnight, from the top down. And when they came to open the door in the morning, the guys that opened the door nearly got drowned. The owner of the hotel was not a happy bunny. It was going to take 6-7 months to dry it out and put it back to where it was. In the meantime, he'd taken on staff. He'd taken bookings. The best one, though, was he had signed up for a celebrity to come and open it for a 5-figure sum, I may hasten to add. And he was going to incur all sorts of other costs, finance charges, the lot. And the contractor was entitled to an extension of time, so he wasn't going to get his LADs. The hotel was repaired, the damage was fixed, and he got his new hotel 7 months later. And it had cost him £250,000 that he had not insured, but he could have done had he been advised correctly by his insurance advisor. He did try to argue that the contractor, AMEC, was not entitled to an extension of time, but that didn't last very long. He did have words with his lawyers and various other people. Whether he sued them, no idea, don't care. His problem. The cover is there, the employer can. And I speak to a lot of employers now, and 75% of them have never even thought about this when they have their works done. And the biggest answer I get, is there any architects here? Oh, good. My architect said I didn't need to worry because it was covered by liquidated damages. I've heard that so often I want to shoot every architect in this country. Stick to designing buildings. Don't start talking about insurance. If you're going to work for an employer, bear that in mind going forwards and raise it with them. It is an important aspect for them to think about. A lot of them have said, oh, our LADs are minimal, Lawrence, but I'm not interested in the LADs. You can't insure LADs. I want to know what's it going to cost you if this project is delayed at the last minute. Chances are it won't be, but it does happen. And another one where, going back to terrorism, one of the biggest bombs in London was in St Mary's Axe. That was outside an AMEC job that was 4 weeks away from completion. That was a £25 million building, brand new office block, flattened. Took another 2 years for us to do the work again. Great for our turnover. Insurers weren't happy because at that time they covered terrorism automatically. That was one of the ones that caused the terrorism to become a problem. But there is an issue there. So, as I say, if you're going to start working on the employer side rather than the contractor side, it's not so much for the contractor, much more the employer. They need to think about it. And that, you'll be pleased to know, is that. I don't know if there are any questions. Are there? Oh, we have one, two. Right. Go on then.
Have you got any other examples of any claims which have involved QSs for the
Professional indemnity? No, the only one that I know of, and I can't go into a lot of detail, is the error in the specification and with QSs as acting as an estimator, misinterpreting the amount of material that should have been priced for. So it ended up costing more than everybody thought. And he just misinterpreted when he was pulling down the amounts.
Do you have to prove that you've misinterpreted it?
Yeah, it's very difficult. You have to get the QS to go, I cocked up, Gov. It wasn't my maths that was wrong, I made a mistake. And of course, it's very difficult because nobody likes to admit that they made a mistake. And I fully understand that. But in the end, this guy did say it. And the claim went through. But it took a long time to do it. And a lot of conversations with him. Not by me, by his bosses. I think I don't know. I didn't get involved in the conversations and I don't want to. But he had to admit he made a mistake. And what the mistake was. But that's the only one really for a QS. Because you don't design stuff, you don't, as far as I know the job of a QS, you're not sitting there designing the steelwork, you're not sitting there designing the building, you're not sitting there making sure that everything's strong enough to take the pressures and all the rest of it, all this technical stuff that I don't understand. One of the things I often have to do is to get technical people to talk plain English, because they go off into a language all on their own. I can do the same with insurance if you want. I can make this even more boring than it probably has been already. But I try and bring it back to plain English. Technical people have the same problem. And QSs, they're really sort of people who are looking at what's happening on site. Is it in accordance with the contract? And is there an opportunity to put a contractual claim in? Very, very simplistic view. May be the wrong view. You may say that's garbage. But that's my view of a QS. Some of the best QSs I know, or knew, were the people that managed to find claims to help push the contract price up. There was a firm of contractors who are no longer around, but I'm not going to name them. First two people on site. First one was a QS, the second one was a lawyer. Before they even started building anything, they were putting together their contractual claims to get the price up. It's life. And that's where I've always felt that the QS was, but that's not going to cause any problems other than you may think of a claim, you get your bosses very excited, and then it turns out that it doesn't exist. And that's just a commercial problem for you internally. But that comes with experience. Gentleman up there.
I was going to say, because the client side would usually specify the amount of liability insurance, is there any come back on the client if he specifies too little?
No.
Just the rest of the contractual costs?
If a contractor says, if the client says minimum level PL cover £5 million, and there's a £50 million claim, and the contractor's only got £10 million, doesn't come back on the client, other than possibly if the contractor then goes bust, people who haven't been paid or in the companies that haven't been paid may try and go for the client, the employer, separately to get what's missing back from them. Difficult, but I've never seen it happen. I just tell people to think about what they're doing, where they're doing it, assess it, look at it, think about it. Is 5 million as a minimum enough? Should you be asking for more? The problem is, if you put in the tender document you want a minimum of 50 million PL, it's going to put the price up. Technically. If it's a major contractor, it won't, because they're probably already charging you for 400 million, even though you've only asked for 5 minimum.
Earlier, you identified insurance contracts as contracts of the utmost good faith. Can you give practical examples or illustrations of what that means for a contractor?
For a contractor. If you're a building contractor and you decide to go off to do some tunnelling work, you have a requirement to tell your insurers that you're doing a new piece of work. They will look at that as a much more heavy risk than straightforward building. If you're going to start selling products, you think that there is a market to be made in making concrete products for you to use yourself, and then you realise that actually we could sell these to the outside world. Well, that's a retailer's risk, not a construction risk when you sell them. So that's another one. It's where you change your business, really, and you start to go off in new areas. And certainly if you decided to start manufacturing aeroplanes, a silly example, something totally new, or a new area, you're going to become an environmental clean-up contractor. Start cleaning up soils and what have you. Anything that's new, and it takes you away from what you've already told the insurer in the first place, is somebody somewhere in the business. It's usually the owner, or if it's a really big organisation like AMEC, it would have been me. We'll have to go to the insurer and say, oh, we're doing something different. I better tell you. But then we did so much that I don't think there was anything new. That I had to actually tell them about, because in a commercial insurance policy you have a business description, and it's that the insurer works on. So get that right. But if it changes, you need to tell them.
I have an idea that, insurance for a specific project, that the contractor needs to be aware of his requirement to continually inform the insurance company where risks, changes or alters over the duration of the project, from plan estimating, etc.
In a project policy, you're more likely to get insurers inspecting the works as it progresses. If it's basically the same, you're going to construct a 10-storey building of concrete with a steel frame, a bit of cladding on the outside. There'll be a lift. There will be all sorts of M&E work going on inside, which you don't have to specify. I mean, insurers know that there's going to be M&E work going on everywhere. If the employer then comes along and says, well, actually, I want to build a helicopter pad on the roof. Yes. It's not really going to affect the build, because there'll be no helicopters landing until after completion. But it's something that I would then go to the insurer and say, there's been a change. If it's just, we're going to change it from a white cladding to a yellow cladding, no, it's the same thing. I mean, it's just change of colour. That's not a problem. Seems to be it.
Okay, so
It's now 7:22 according to this.
Lawrence has been kind enough to come and talk to us about insurance tonight, but in addition, we're just going to stop for 5 minutes, and then he's going to give a very, very snappy session on bonds. It's probably going to last 10 or 15 minutes, but it's one which I think you'll find interesting. So we're just going to break for 5 minutes, give Lawrence his vocal cords to rest, and then we'll plough through in 10 or 15 minutes of this next session.
So if you were 70% underinsured, you only got 70% of your claim.
Yeah, I've had more arguments about that when I work for insurance companies than anything else.
Yeah.
From people phoning up and saying, but why have you stopped building? Well, you've run out of money.
Yeah.
You've just underinsured it. Yeah. We think on purpose, but I could never say that.
Yeah.
But you knew they'd done it on purpose. There we go.
Okay, everyone gets back to it then.
Yeah.
Is this, by the way, is this working all right?
Yeah, it's working.
I bet it should be.
Okay, so let's just come back quickly, settle down, and we'll just move on to this next subject. Like I mentioned, this particular subject is certainly a lot shorter, and following that, obviously, Lawrence will take some questions.
Possibly. I'm not a bonding expert by any means. Within AON we have our own team who do this day in, day out. I've spoken to them, I've asked them questions, and I'm here talking about it. They can talk about this for a day at least. We're just going to look at what are they, what types, the issues, benefits. I'm not going to get too technical. It's very rare that QSs get involved in bonds other than when they're called, because there's a problem on site, whatever it might be. Usually they're set up by the finance people. Why are they needed? Who requires them? Can you say no? That's an interesting one. I think the answer to that is no, you can't. Because if you don't produce the bond, you don't get the job. Two places to get a bond, bank or an insurer, and I'll explain about that best I can. What are they? What is the bond? It's a guarantee to pay the beneficiary for a direct loss arising out of the contractor's breach of contract or insolvency, in very, very simplistic terms. Usually it means the contractor's gone bust partway through a job and the employer will pull, what I call pull, demand payment from a performance bond because he's going to incur costs in bringing another contractor in to finish it off. But it's those four words: guarantee, direct loss, breach of contract, insolvency. Types, well, in this country, the biggest one is performance bond. Will the contractor finish the job? Usually 10% of the contract price. I have heard stories, or I've been told that there are stories, some people are asking for 20% because of the financial times we are in. If you're in America, should you be fortunate enough to get a job out there, they used to, as far as I know they still do, demand 100% bond on the contract price. So every job you've got where you're required for a bond, it's 100%. There's an advance payment bond. Contractor, the employer's giving you money before you've even started work to help out with the cash flow. They will want a bond back such that if you go bust and you haven't actually done enough of the works to cover that advance payment, they're not out of pocket. And it does happen. I mean, people do put up advance payments because it helps with the pricing. Retention bond. Don't think these are used much these days, from what I can make out. But of course, on every job, contractor will finish, go off site, agree the final account, get paid, but there will always be a retention from the employer who will sit on 5% maybe of the contract price until the defects period is over, 12 months down the line. In case there are problems and you don't come back as a contractor. You can get bonds to cover those. Very rare from what I can make out. Road and sewer, really if you're into house building, local authorities want bonds because you've put the roads and the sewers in, and if something goes wrong in the first 12, 24 months, they want something that they can rely on if you're not there to fix it. And there used to be tender bonds, particularly in the Middle East, where the employer would demand that when you put your tender in, you put a bond with it. And the idea was that it made the contractor think about their tender and not mess around with it and put qualifications in when there shouldn't be. But what tended to happen, as far as I can make out, was that when they opened the tender, certain unscrupulous employers would find any reason to disqualify the tender and therefore call the tender bond. They weren't big sums of money, but it all added up. I don't think they're used these days, as far as I'm aware. Issues. Two places to get a bond from: a bank or an insurance company. The people who write these bonds for either the bank or the insurance company will know more about the contractor's finances than probably the contractor does. Because the whole point of a bond is if the bank or the insurer has to pay out, they'll come looking for the contractor because they will have a counter indemnity from the contractor to repay them. And there will be occasions when, if it's a breach of contract, the contractor is still trading, they want their money back. Normally it's because the contractor's gone bust, which is why they tend to delve into your finances very deeply. I mean, AMEC, the bonds people we used, who were insurers, not bankers, used to meet the group finance director 4 times a year to discuss the finances of AMEC. And he used to go over to America to see the people there. The facility we had in America was $1 billion bonding facility. So they want to make sure that if they're putting these bonds out there, that AMEC is going to be around. So it's all to do with credit standing, it's all to do with counter indemnity. Apparently, insurers are cheaper. No idea why. The other benefit for an insurance bond is, from a finance point of view, it doesn't affect a company's ability to borrow money. With the banks, they put that into the pot for borrowing money. And I'm getting into financial areas that I don't quite understand, but it's better to be with the insurer, not the banks, so I'm told. Benefits, it provides comfort to an employer. If you can provide the bond, there's a good chance that you're not going to go bust. Not a perfect way, but there's a good chance that you're financially stable. It helps to pre-qualify for bids. There are agreed wordings now with the insurance market, certainly, on bonding arrangements. And if anybody tries to go against those from an employer's point of view, the bondsman will often say, well, I'm not prepared to do it. That doesn't mean to say that there's anything wrong with you financially. It means that they don't like the words in the bond. That's about the limit of my knowledge. So it's something to delve into if you wish to, but quite often, these things are sorted out by the financiers. And leave them alone, is my view. Questions that hopefully I can answer. Okay. Nobody's thought of anything from the last bit. Oh, question?
How do you get one then? Sorry, what does a company need to do? Do you pay like a premium?
Oh, you pay a premium. It's like 1% of the bond, value of the bond. But don't quote me on that. You pay a premium. You just approach your financial advisor. Or you come to a company like, I'll do the sales pitch, you come to a company like AON, we have a whole unit who deal with this day in, day out in London. And they can advise you where to go, what to do, how to do it, set up facilities and all the rest of it. Anybody thought of anything from the last session that they want clarification on? Yep.
Just on the bonds, actually, I'm just wondering why is the industry standard only 10%?
I've no idea. I haven't got the faintest idea. When you go to, as I say, you go to America, it's 100%. Why is it 10%? I suppose it's a bit like, why do people put 5 million as the minimum level of PL cover? There's no rhyme or reason.
10% bond is making the assumption that there's only going to be an issue with 10% of the value of the work left to go in.
I suppose if you think about it, the employer still has the money left to complete the works that he was going to pay you. It's the additional cost of bringing in another contractor. Is that going to be a lot? I honestly don't know.
Yeah, the idea is that the 10% covers the cost to get to rather finish a project that's almost complete, or the 10% would cover, like Lawrence said, to bring on a new contractor, and hopefully at that stage you would have some of your contract sum remaining to actually engage another contractor. So
As an employee,
just fills the void.
you've probably got money that you haven't paid the contractor yet with outstanding accounts. You would have the retention fund anyway, and any other arguments you can think of not to pay them, particularly if they've gone bust. But as I say, there is a rumour that there are stories around that people are asking for 20% now. Well, thank you for your attention. I hope you got something out of it. I hope you take an interest in insurance on contracts. Final message. Don't leave insurance to the last minute because it causes problems. Deal with the insurance aspect as early as you can in the contract of the tender period, not the last second. And certainly not once you've started. That's far too late. Thank you for your time.